At first, it looked like a distant shock, something unfolding far from trading floors in London, Frankfurt, or New York. A war confined to maps and headlines. But within days, screens across the world began to flicker red. Currencies wobbled. Energy prices surged. Investors stared at numbers that no longer behaved the way history said they should. What few realized in that moment was that Russia had triggered something far larger than a geopolitical standoff. Beneath the surface, a hidden financial chain reaction was spreading quietly through global markets, touching pensions in Europe, food prices in Africa, factories in Asia, and household budgets everywhere. This wasn't just about sanctions or oil. It was about trust in money, in systems, in the invisible agreements that hold the global economy together. Analysts whispered questions they rarely asked out loud. Could a single country fracture decades of financial globalization? And more unsettling still, could this happen again, somewhere else? As policymakers scrambled and traders recalculated risk, ordinary people felt the consequences in subtle but lasting ways. Higher prices. Uncertain jobs. A sense that the world economy had become less predictable overnight. If stories like this fascinate you, subscribe to join us as we uncover hidden global truths. And tell us where you are watching from. Could this kind of shock ripple through your country too? The first shock did not arrive with explosions or speeches. It arrived quietly, through paperwork, legal notices, and urgent calls between central banks. As tanks crossed borders, something else crossed a threshold: the weaponization of the global financial system at a scale never attempted before. Within days, Russia found itself partially cut off from the arteries of global finance. Major banks were frozen out. Foreign reserves, hundreds of billions of dollars painstakingly accumulated, were suddenly unreachable. To policymakers in Washington and Brussels, this was economic pressure. To markets, it was something far more unsettling: proof that money itself could become politically conditional. In dealing rooms from Tokyo to Zurich, traders paused. Not because they didn't understand sanctions, but because they did. The modern global economy runs on assumptions of access, convertibility, and trust. And now, one of those assumptions has been cracked. If reserves held in foreign currencies could be frozen overnight, what did safe really mean anymore? The ruble collapsed, then rebounded in ways that defied logic. Energy prices surged as Europe confronted a truth it had long postponed: its dependence ran deeper than contracts and pipelines. Meanwhile, countries far removed from the conflict began to feel the tremors. Importers in Africa watched food prices climb. Asian manufacturers faced volatile input costs. Pension funds in Europe quietly adjusted risk models built for a calmer world. Behind closed doors, finance ministers asked questions they never expected to ask. Has globalization gone too far to reverse, or has it always been more fragile than advertised? And if Russia could be isolated this way, who might be next? What began as a targeted response was starting to look like a stress test for the entire global financial order. As the days passed, the deeper consequences of the sanctions began to surface, not in headlines, but in balance sheets. Western companies with decades of investment in Russia suddenly faced an impossible choice: stay and risk reputational damage, or leave and write off billions overnight. One by one, they pulled out. Factories went silent. Supply chains snapped with a dull, echoing finality. In Moscow, emergency measures were rolled out with astonishing speed. Capital controls tightened. Interest rates were raised sharply. Energy revenues were redirected, not toward growth, but toward survival. The Russian economy adapted, but at a cost that would only become clear months later. For markets watching abroad, the message was chilling: economic isolation was survivable, but distortion was inevitable. Across Europe, energy traders watched gas flows like doctors monitoring a patient's heartbeat. Any fluctuation sent prices soaring. Governments rushed to shield households from bills they could no longer explain. In Asia, finance ministries quietly studied their own exposure to dollar-based systems, wondering how insulated they really were. What unsettled analysts most was not the immediate volatility — markets are built for shocks. It was the precedent. Never before had a G20 economy been so comprehensively cut off from the financial infrastructure it helped build. The rules of the game hadn't just changed, they had been rewritten in real time. And beneath it all, a quiet realization spread through capitals and boardrooms alike: the global economy had entered a new phase, where geopolitical alignment mattered as much as creditworthiness. The chain reaction had begun, but its most destabilizing effects were still ahead. By the time markets fully grasped what was happening, the damage was no longer localized. What began as a financial isolation of Russia had mutated into a global recalibration of risk, fast, uneven, and deeply unsettling. Investors across Europe watched in disbelief as energy stocks surged while everything else sagged under the weight of uncertainty. Volatility became the new baseline. The bond markets reacted first. Yields jumped sharply as governments prepared to borrow at levels not seen since earlier crises. Inflation, once dismissed as transitory, now felt structural. Central bankers found themselves cornered: raise rates and risk recession, or hold steady and let prices spiral further. Either path carried consequences far beyond their borders. In emerging markets, the shock landed harder. Currencies weakened as capital flowed back toward perceived safety. Food importing nations faced a cruel arithmetic: higher grain prices, weaker exchange rates, and shrinking fiscal space. For millions of households, the war translated not into geopolitics, but into thinner meals and postponed plans. Meanwhile, global corporations began rewriting their maps. Supply chains that once prioritized efficiency were suddenly redesigned for resilience. Friendshoring replaced free trade in executive conversations. Factories moved. Contracts were renegotiated. Entire regions felt the quiet withdrawal of capital that never made the news. What haunted analysts was how quickly confidence evaporated. Not just in Russia, but in the idea that markets were neutral spaces, insulated from politics. Screens flashed data, but beneath the numbers lay a deeper anxiety. If trust could disappear this fast, what else was vulnerable? And as winter approached in Europe, the most uncomfortable question lingered in trading rooms and ministries alike. Had the world underestimated how deeply this financial shock would cut? As the months unfolded, the chain reaction revealed itself in unexpected places. Insurance markets quietly adjusted premiums on shipping routes that had suddenly become politically sensitive. Commodity traders rewrote contracts, inserting clauses that barely existed before: force majeure not for weather, but for geopolitics. Risk, once a spreadsheet abstraction, had become tangible. China watched closely. Publicly cautious, privately analytical. Beijing's economists studied how swiftly access to dollar liquidity could vanish, how reserves could be rendered symbolic. In response, trade settled increasingly in alternative currencies. Small shifts at first, experimental, almost invisible, but meaningful in their intent. Across the global south, similar conversations unfolded, often away from cameras. In Europe, governments faced a reckoning with their voters. Energy subsidies ballooned. Budgets strained. The political cost of economic decisions became unavoidable. Elections turned on gas prices. Protests flared, not against war itself, but against the rising cost of daily life. The financial chain reaction had crossed from markets into the streets. Even in the United States, distance offered no immunity. Higher interest rates cooled housing markets. Stock portfolios thinned. The sense of post-pandemic recovery gave way to a more sobering realization: global shocks now stacked, one atop another, with little time to absorb them. What made this moment different wasn't just scale, but synchronization. Financial systems, energy markets, and political institutions were all reacting at once, amplifying each other's weaknesses. For the first time in decades, globalization felt less like a safety net and more like a transmission line. And as capital slowly reorganized itself along political lines, one quiet truth emerged: the era of frictionless global finance was ending, whether the world was ready or not. Long after the headlines faded, the deepest changes continued in silence. They unfolded not in emergency meetings or breaking news alerts, but in policy drafts, reserve allocations, and the cautious language of central bank reports. The financial chain reaction Russia unleashed was no longer a shock, it was becoming structure. Around the world, governments began to rethink what security truly meant. It was no longer just about armies or borders, but about payment systems, currency exposure, and who ultimately controlled access to money. Gold quietly returned to prominence. Bilateral trade agreements multiplied. Digital currencies moved from theory to contingency planning. For smaller nations, the lesson was sobering. Neutrality, once a shield, felt thinner in a world where financial alignment could determine economic survival. Finance ministers in Africa, Southeast Asia, and Latin America studied the crisis not as observers, but as potential future case studies. The question was no longer if shocks would come, but how to endure them. Even global institutions seemed to speak differently now. Their tone grew cautious, their forecasts hedged with uncertainty. The confidence that once defined globalization had softened into something more fragile, more conditional. Trust, it turned out, was the rarest currency of all. And yet, beneath the anxiety, there was clarity. The world had seen the wiring behind the walls. The illusion of a neutral financial order had dissolved, replaced by something more human, more political, and far more complex. The rewrite was underway. Quiet, irreversible, and still unfinished. For ordinary people, the transformation was harder to name, but impossible to ignore. Prices behaved differently. Jobs felt less secure. The future, once planned in steady increments, now came with caveats. In subtle ways, the global economy felt closer and more fragile than ever before. Across continents, a quiet cultural shift took place. Trust in abstract systems weakened, replaced by a renewed focus on local resilience. Nations spoke more openly about self-sufficiency. Communities talked about energy, food, and currency not as distant policy issues, but as matters of daily life. The financial chain reaction had filtered down, reshaping how societies understood risk itself. Historians would later argue that this was the moment global finance lost its innocence. Not because interdependence ended, it didn't, but because its cost became visible. The world learned that efficiency had a price, and that political fractures could travel faster than capital ever had. And yet, there was no clean ending. No dramatic collapse. Just a gradual acceptance that the rules had changed, and that certainty was no longer guaranteed by spreadsheets or treaties. The markets moved on. So did governments. But the memory remained, a quiet awareness that power, money, and trust were now openly intertwined. In the end, Russia's financial shock was not just about one country or one war. It was about a world discovering how tightly it was bound together, and how easily those bonds could strain. In the end, this story is not only about Russia, sanctions, or markets flashing red. It is about a world coming to terms with its own interdependence. The realization that money is never just money, it is memory, power, and trust layered over decades of cooperation. Global finance will continue to evolve, adapt, and connect us in new ways. But beneath every transaction now lies a quiet question, learned the hard way, not just what is possible, but at what cost. Because when the invisible systems that bind the world are shaken, their echoes are felt everywhere, from trading floors to kitchen tables, reminding us that in a connected world, no shock is ever truly distant.